Hello and welcome to the session today. Let's wait for about 3 or 4 minutes, let everyone join in, and then we start. Let's wait for about 3 or 4 minutes. Let's wait for about 2 or 3 minutes, let everyone join in, and then we start the session. Come on, quickly, everyone settle down. Come into the session. All right, just wait for another 2 minutes, let people join in, and then we start. Okay, settle down, everyone. Two more minutes. Another minute or so, and then let's start off. All right, settle down. Another minute or so, and then we start off. 10 more seconds. All right, let's start off. Okay, all set? All right, let's start. Welcome to Unacademy, India's largest online learning platform that gives you a world of courses, resources, content, live and recorded sessions to help you in your preparation for the CA Foundation and intermediate examinations. And also, welcome to Crack CA exams with us. Welcome to Crack CA exams with us, which is a channel and a vertical of Unacademy that caters to the students of CA Foundation and Intermediate in their journey and pursuit of preparation for CA Foundation and Intermediate examinations by providing top educators, quality content, and overall a great learning experience. So come, let's crack CA exams with Unacademy, India's largest online learning platform. Welcome to the session once again. Before we proceed, a brief introduction about the educator today, that is me. Hello, I'm Prathik Gupta. I am a Bachelor of Commerce from Christ College, Bangalore University. I am an associate member of the Institute of Chartered Accountants of India, an associate member of the Institute of Cost Accountants of India, and an associate member of the Institute of Company Secretaries of India, and also a law graduate from Karnataka State Law University. I'm currently a practicing chartered accountant and also a visiting faculty for CA subjects and an educator for CA students both offline and online. Prior to starting on my own, I worked with SR Bartley Boy and Associates, that is the Indian member firm of Ernst & Young Global in the audit and assurance department. Then I went on to work with Ernst & Young India in the mergers and acquisitions department. Post that, I went on to work with the Manipal Group in Bangalore as the corporate controller of their Indian entity as well as the German subsidiary located in Frankfurt, Germany. And it was only after I got back from Frankfurt, Germany that I decided to start something on my own. And that also gave me an opportunity to become an educator, which in turn today has given me this opportunity to be able to take this session for you young, fine and enthusiastic CA aspirants. Thank you so much for giving me this opportunity and I hope you find the session useful. During the course of the session, in case you have any questions, queries, observations or discussions to be made, please do not hesitate to drop in a line and I will take up the matter for discussion or for problem solving as soon as I can. All right, so once again, welcome to the session, and also with my name, that is Prathik Gupta. Just check the spelling, Prathik Gupta. You can look me up on the YouTube channel of Unacademy to go through all the other various sessions that I have taken on the YouTube channel of Unacademy to help you in your preparation. And with this name, you can also look me up on the Unacademy Learning app to go through all the hundreds of hours of special classes that I have taken there on the app, which will help you in your preparation for the CA Foundation and Intermediate examinations. So it is Prathik Gupta. All right, yeah. So now, like I told you, Unacademy helps you in your preparation for the CA Foundation and Intermediate examination. It does so through 3 platforms. So 3 platforms are YouTube, special classes, and its premium platform, which is the Plus platform, which is also a payment-based subscription model. More about the packages, which I will tell you in future. Now, the YouTube and special classes are absolutely free, but they provide immense value and resources to help you in your preparation for the CA Foundation and Intermediate examinations. YouTube sessions are what you're watching right now. You can look me up or you can attend these sessions on the YouTube channel of Unacademy absolutely free. And but it is very resourceful. Same time, the special classes of YouTube of Unacademy are available on Unacademy Learning app, which are also free of cost but provide immense value to help you in your preparations. Okay, now let's talk about the Plus platform of Unacademy. The Plus platform of Unacademy is the premium platform of Unacademy, which is also a payment-based subscription model. Okay, and I strongly recommend and encourage you to become part of the Plus platform of Unacademy due to the following reasons. Firstly, because it provides daily live classes where you get to chat with your educator, engage in discussions, ask your doubts and answer polls, all this while the class is going on. Yes, you heard it right, all this while the class is going on. You do not need to wait for the end of the class, you do not need to wait a couple of days after the class, or you do not need to wait for the weekend after the class. Neither do you have to wait to fix up an appointment with your educator. You can ask your doubts and discuss matters with your educator then and there on a real-time basis. It is as good as lifting your hands up in a live classroom, and your educator will be happy to answer your questions and queries. The second reason why I encourage and recommend you to become part of the Plus platform of Unacademy is because of the live tests and quizzes it conducts on a periodic basis to help you evaluate your preparation and also get a detailed analysis of your performance. So you might wonder, what is this evaluation and analysis of the performance that I'm talking about? It is nothing else, but please remember, once you prepare for a professional examination, it is always nice to measure from time to time your level of preparation for the examination, that to which areas you're prepared, which areas you need more preparation, which areas you require a little less preparation, and which areas you require external help. So basically, the Plus platform of Unacademy breaks up your preparation into three areas. Those are your strong areas, your weak areas, and your not so strong areas. So that whatever limited time for preparation you have, you can accordingly spend it on those three areas. That is, less time on your strong areas, a little more time on your not so strong areas, and more time on your weak areas, until a time when your not so strong and weak areas eventually become your strong areas. Thereby, the Plus platform of Unacademy ensures that the minimum time is wasted and maximum time is utilized in your preparation. The third reason why I recommend and encourage you to become a part of the Plus platform of Unacademy is because of the structured courses it provides. All the courses are structured in line with your exam syllabus to help you best prepare for it, which simply means all the Plus courses on the Plus platform are in line with the syllabus of your examinations. And once you complete a Plus course on the Plus platform, you can rest assured that you have completed the syllabus of your examination without missing out on any important or major point. And lastly, and most importantly, the one subscription to the Plus platform of Unacademy gets you access to all the live and recorded courses to watch from the comfort of your devices. Now, what does this mean? It means the one subscription to the Plus platform of Unacademy will give you access to all the live and recorded Plus courses, all the live and recorded special classes that Unacademy has to offer you to help you in your preparation. And you can view all these sessions from the comfort of any of your devices. Like, you can view it from your mobile phone, laptop, desktop, or tablet, as the case may be. And not only this, all these sessions and live record courses are available 24/7. You can access them 24/7 without any timing restrictions like 10 to 5, 10 to 6. You don't have to worry about it. Whenever you have the time to prepare, just pull out your mobile phone, log into the Unacademy Learning app, and start your preparation for these examinations. Hang on, there is another additional feature. The additional feature is this: all these resources and recordings are available to you at any location. It could be when you're at home, whether you're returning home from work, or you're traveling to work and you have some time to spare, or you're waiting for someone for a meeting, or you're on a vacation, or you're in your native place and you want to prepare for your examinations. You don't have to worry about anything. Just pull out your mobile phone, log into the Unacademy Learning app, and start preparing for your examinations. All you require is an internet connection or a data plan, which all of us are blessed with today. So keeping all this in mind, I strongly recommend and encourage you to become part of the Plus platform of Unacademy in order to accelerate and enhance your preparation for the CA Foundation and Intermediate examinations. All right, please take about a minute on this slide. Any questions, please ask. Take about a minute. Any questions, please ask me. Okay, just about 10 more seconds and then we start. All right. Okay, so like I was telling you about the Unacademy Learning app, for those of you who have downloaded the Unacademy Learning app and are using it, I thank you very much, and I request your support in the future as well. And for those of you who have not yet downloaded the Unacademy Learning app, just a second. Okay, and for those of you who have not yet downloaded the Unacademy Learning app yet, I request you to go to the Play Store on your mobile phone, Download the Unacademy Learning app, put in your mobile number where you get an OTP, put in the OTP, and you are registered. You're done. There is no other complicated or lengthy procedure that you need to follow. And in case you find any problems, you can always chat with us to get a timely solution. Now, you might ask me, okay, I downloaded the Unacademy Learning app or registered on it and other things. So what? So once you register on the download the Unacademy Learning app, you get access to all the live and recording special classes that Unacademy has to offer to you to help you in your preparation for the CA Foundation and Intermediate examination. And not only this, it gives you access to all the live and recorded plus courses that Unacademy has to offer to you in order to accelerate and enhance your preparation for the CA Foundation and Intermediate examinations. So keeping these things in mind, please go ahead, download the Unacademy Learning app, make use of it, register on it, and take advantage of it in your preparation for the CA Foundation and Intermediate examinations. And not only this, also spread the word around you about these Unacademy Learning app. Help people around you to download and install the Unacademy Learning app on their phones and help them register on it using their mobile numbers and OTP, and also to make use of all the resources that are there in store, the Unacademy Learning app, to help them in their preparations. Please take about a minute, go through the slide, and then we proceed. Any questions, please ask. Take about 30 more seconds. Any questions, please ask me. It's a very easy procedure, a very non-tiring procedure to register on the Unacademy Learning app. Try it. It's very easy. Okay, now like I told you, the Plus platform of Unacademy is the premium platform of Unacademy, which is a payment-based subscription model and which provides you various subscription packages to choose from. So accordingly, the CA Foundation and Intermediate subscription packages provided by the Plus platform of Unacademy are as follows. The packages provided are for 1 month, 3 months, 6 months, 12 months, and 24 months. The 1 month package will normally cost you rupees 3,500. The 3 month package will cost you rupees 8,750. The 6 month package will cost you about 14,000 rupees. The 12 months package will cost you about 17,500, and the 24 months package will cost you rupees 21,000 rupees. Now please remember, all these are the list price of the various packages. But before you make the payment of your package, please do not forget to use the code Prathik, PRATHIK, to get an instant discount of 10% on the above listed price. I repeat, please do not forget to use the code Prathik to get an instant discount of 10% on the above listed price. So the after discount price of the various packages are as follows. The 1 month package will cost you rupees 3,150. The 3 month package will cost you rupees 7,875. The 6 month package will cost you rupees 12,600. The 12 month package will cost you rupees 15,750, and the 24 months package will cost you rupees 18,900. So you see immediately there is a savings of 10% that you've got when you've used my code. I will personally recommend you to start off with the 12 months package at least, because of the following two reasons. Firstly, it is cost effective. If you compare the per month cost of the 12 months package and compare it with the 1 month package cost, you will see you have great savings immediately. And secondly, and most importantly, since the CA Foundation and Intermediate course is provided to you in one package, a 12-month package will be very beneficial to you, because the package covers the entire duration of these two courses, that is the CA Foundation and Intermediate examinations, and it normally takes about a year's time for you to prepare and clear these examinations. So a 12-month package will be very resourceful and of value to you. But having said this, you're free to choose the package of your choice. But before you make the payment, please do not forget to use the code Pratik to get an instant discount of 10% on the above listed price. You can also avail the no-cost EMI option available for 6 months, 12 months, and 24 months packages, just in case you do not wish to make the entire payment at one shot. The payment options available to you are internet banking, debit card, credit card, and also all the coins that you've accumulated while watching the special classes can be redeemed when you're making the payment for the plus courses. So keeping these views in mind and the packages, please go ahead and become a part of the Plus platform of Unacademy as soon as possible in order to accelerate and enhance your preparation for the CA Foundation and Intermediate examinations. Please take about a minute or so, go through this slide, and then we proceed. Any questions? Please ask. Any questions? Please ask. Okay, take about a minute more. Any questions? Please ask me. Take about 30 seconds more. Any questions? Please ask me. Okay, like I told you, the Unacademy Learning app houses all the live and recorded special classes that are available to you to help you in your preparation of the CA Foundation and Intermediate examinations. Here are the snapshots of few of the many special classes that I have conducted on the Unacademy Learning app and which is there at your disposal to help you in your preparation. There are special classes on Revision Test Paper, Sale of Goods Act, Indian Contracts Act, Companies Act, Fundamentals of Accounting, revision on partnership accounts, retirement, death, or admission of partner, valuation of inventories, revision on final accounts of non-manufacturing entities, and revision on sale of goods on approval or return basis. So these are few of the many special classes that I've taken. There are many other special classes which will help you. So please get on to the Unacademy Learning app as soon as possible. Look for my profile, Prathik Gupta, PRATHIK and you will find all my special classes there. Go on, make use of them, and always come back to me for any questions or queries that you may have. Similarly, now I have given down the list, the links of few of the many special classes that I have conducted on the Unacademy Learning app. You can either copy and paste this link on your browser or click on these links to directly take you to the Unacademy Learning app and my special class. There are special class on Indian Contracts Act, Sale of Goods Act, Indian Partnership Act, Limited Liability Partnership Act, Companies Act, Basics of Communication, Accounting Concepts, and Revision Test Papers, among many others. Please take a minute, go through this, and then we proceed. Any questions? Please ask. Take about a minute. Any questions? Please ask me. Okay, so let's start off with today's topic, that is income from house property under the Income Tax Act 1961, Part 1. All right, so let's see if we can wrap up this whole topic in today's session, or else we will do it in the next session. All right, so income from house property. So now we have discussed in the previous sessions, we discussed the residential status based on which the income is taxed every year. Similarly, there are 5 heads of income under the Income Tax Act. One is income from salaries. So any person earning salaries will fall under this. Then is income from business or profession. If anyone carries on any business or profession. Business means anything. It could be a manufacture, trading, or service, or anything. And profession is something like mine. As a chartered accountant, what profession I carry, doctors, lawyers, architects, all these are professionals as well. Then you have capital gains. Capital gains is when any capital property like house, shares, is land is sold, whatever gains you get on that, those are taxed under capital gains. And then you have income from other sources, that is the residual sources, which do not fall under the above four heads of income. The second head of income being income from house property, what we're going to discuss today. It simply means if you have a house property, so whenever you have a house property and you let it out on rent, so whatever rental income you get from that will be taxed under income from house property. So this was just a very broad outline that I gave you, and the minute details we will discuss as we move in today's session about income from house property. All right, so all get up. Let's start off. Okay, now we look at chargeability, section 22. The process of computation of income under the head income from house property starts with determination of the annual value of the property. The concept of annual value and the method of determination is laid down in section 23. The annual value of any property comprising of building or lands appurtenant thereof, of which the assessee is the owner, is chargeable to tax under the head income from house property. Okay, so it simply means the annual value of any property comprising of buildings or land connected with those buildings and is given out on rent is charged, and which the assessee is the owner is chargeable to tax under the head income from house property. So first step of computing the income from house property is determination of annual value. Okay, so in this we have two steps. First we calculate the gross annual value, then we calculate the net annual value, and then we make any deductions that are applicable and allowable, and then that's how we arrive at the income from house property. Okay, so first we will determine the gross annual value, and next we'll determine the net annual value. So please take about 2 minutes, go through this slide, and then we proceed. Any questions, please ask me. I'm going to take it nice and easy so that you understand everything. You get ample time to read it and understand it, and ask me any doubts that you may have. Okay, take about 2 minutes, go through this. Any questions, please ask me. Take about a minute more. Any questions, please ask. Okay, now the conditions for chargeability. Okay, now for any income to be charged under the head income from house property, these are the conditions. Only then can it be charged under income from house property. What are the conditions? The first one, the property should consist of any building or land appurtenant thereto, which means building include not only residential buildings but also factory buildings, offices, shops, godowns, and other commercial premises. Okay, land appurtenant means land connected with the building like garden, garage, etc. Okay, so these are the additional things that are connected with the building. So first condition is the property should consist of any building or land appurtenant thereto. So the buildings not only include residential buildings but also factory buildings, office buildings, shops, godowns, and other commercial premises. The land appurtenant means land connected with the building like garden, garage, etc., which are additional fittings kind of a thing. Okay, then you have a second one, the assessee must be the owner of the property. Please remember, this is a very important condition. Owner is the person who is entitled to receive income from the property in his own right. That means he should not be receiving it on behalf of someone else. The person who is receiving rent should be entitled to receive rent from the property in his own right. That means he should be the owner of the property. The requirement of registration of sale deed is not warranted. So even though a property might be sold to someone, but the sale deed might not yet be registered, but the whole fact that a sale deed has been made may give the other person the right to receive the rent. So the requirement of registration of the sale deed is not mandatory. even if without the registration of the sale deed, if someone is entitled to receive the income from the property, he will be deemed to be the owner. Ownership includes both freehold and leasehold rights. So if a property is given on lease, then it is known as a leasehold right. So leasehold rights, or whether it's freehold, ownership includes both of them. That is, whether a property is given on lease or it's not given on lease, it will be deemed to be the owner. Ownership includes deemed ownership. Now, ownership also includes deemed ownership. Now, deemed ownership means in certain transactions, the person is deemed or assumed to be the owner of the property, and or when he transfers it just to avoid taxes or something, or the whole transaction of transferring it is not valid. In that case, he will still be deemed to be the owner of the property, and the income will be charged in his hands. And lastly, the person who owns the building need not also be the owner of the land apartment which it stands. So it's not necessary that the land on which a building has been created or constructed is also owned by the same person. There could be a situation the land is owned by someone else and the building is owned by someone else. In that case, the income from house property will be charged in the hands of the person who owns the building. All right. So these are the initial two conditions for chargeability. There are more conditions to this. So first is property should consist of any building or land appertaining thereto. And secondly is assessee must be the owner of the property. And we discussed each points in detail. I request you to take about 2 or 3 minutes, go through this. Any questions, please ask me. Okay. Please go through it in detail. Understand it. Any questions, you can ask me. Take about 2 more minutes. Any questions, please ask. You need to carefully go through this. These are the conditions for chargeability. Take about a minute more. Any questions, please ask. Take about a minute more. Any questions, please ask me. Carefully go through this. Let me know once you're done. Okay, are we done? All right. The third condition, the use of property. The property may be used for any purpose, but it should not be used by the owner for the purpose of any business or profession carried on by him, the profit of which is chargeable to tax. So the property, basically the property, building property can be used for any purpose, but it should not be used by the owner for the purpose of any business or profession carried on by him, the profit of which is chargeable to tax. So in case it is used by him for the purpose of business or profession carried on by him, then the income will not be chargeable to tax, or it will not come under the heading income from other sources, or sorry, income from house property. Okay, pardon me. Now, property held as stock in trade. The annual value of a house property will be charged under the head income from house property where it is held by the SSE, stock in trade of a business also. However, the annual value of the property being held as stock in trade would be treated as nil for a period of 2 years from the end of the financial year in which certificate of completion of construction of the property is obtained from the competent authority if such property is not let out during the period. Okay, now for whom does this clause apply to? This clause applies to builders. Normally builders build those huge buildings, and they have, let's say, a builder has built a huge building with about 1,000 flats. Okay, so those properties for him are stock in trade. For him it is not an investment, but it is stock, right, which he can sell off to people. So it's not an investment for him or house property for him. So in this case, whatever are the stocks that he has or the units that he has as stock in trade will be treated as will come under the income from house property, but the annual value of each of those units will be taken as zero for 2 years only, for a period of from the time when he gets the completion certificate of the property from the competent authority. After 2 years, it will be deemed let out during the period in case he doesn't even let it out. So for example, if a builder has constructed a property on 1st Jan 2020, so for 2 years from there, 1st Jan 2020 to 1st Jan 2022, the units are held as stock in trade. The annual value will be taken as zero. But after 2 years, it will be deemed let out. Now, what is deemed let out? Deemed let out means it will be assumed to be rented out to someone. And what will be the rent? The rent will be the flat that around the area, a common flat, is earning. Okay, so you are getting that exemption only for 2 years. After 2 years, it has to be let out, or it will be taxed under deemed let out. Okay, please take about 2 or 3 minutes, go through this. Any questions, please ask. Take about 2 or 3 minutes. Any questions, please ask me. All right, any questions? Take about a minute more. Any questions, please ask. Take about a minute more. Any questions, please ask me. Let me know once you're done. Another 30 seconds, and then we proceed to the next slide. I hope you've got it. I hope you've understood it and you have no doubts about it. In case you do, please ask me. I'll be happy to answer your queries. Okay. Then now let's talk about composite rent. So now we spoke about the conditions, right? For the income to be charged under the income from house property. Now let's look at what is composite rent. This is an important concept as well. So please pay attention. Meaning of composite rent: the owner of a property may sometimes receive rent in respect of a building as well as other assets like say furniture, plant and machinery. Okay, or for lifts and services provided in the building, for lifts, service, power backup, etc. The amount so received is known as composite rent. So it means when a owner gives you a, let's say he gives you a semi-furnished flat on rent, which semi-furnished means it's got furniture and some machinery, fans and other things put inside, and also you pay for the different services in the building like lift, security, power backup in huge apartments. In a lot of apartments, those are also known as maintenance charges, which are charged separately. Okay, so when rent is charged with all put together, like say for the building or for the bill for the flat, as well as the furniture, plant and machinery, as well as the other services like lift, security, power backup, when the entire thing is charged as a lump sum amount, that lump sum amount is known as composite rent. Okay, are we clear about this? Composite rent. Please take about a minute, 2 minutes, go through this. Any questions? Please ask. Take a minute more. Any questions? Please ask me. Let me know once you're done. Another 30 seconds. Are we done? So now let's see how the treatment of the tax treatment of composite rent. Where the composite rent includes rent of building and charges for different services, lift, security, etc. The composite rent has been split in the following manner. Okay, so when the rent, let's say a person is charging you 20,000 rupees per month as rent, the composite rent, and where the composite rent includes the rent of building and charges for different services like lift, security, the composite rent has to be split up in the following manner. That is, the sum attributable to the use of property is to be assessed under section 22 as income from house property, and the sum attributable to use of services is to be charged under the heads business or profession, business and gains of profession, or under the head income from other sources as the case may be. So let's say there is a rental composite rent of 20,000 being charged. Out of 20,000, 18,000 is the rent for the building, and 2,000 is for maintenance charges. These 2,000 can either come as profits and gains of business or profession, or under income from other sources as the case may be, and this 18,000 will be charged under section 22 as income from house property. Okay, if you're able to break it up. The manner of splitting up: where the composite rent is received from letting out of building and other assets like furniture, and the two lettings are not separable. That means you cannot separate this 20,000, you cannot separate how much is for building and how much is for services, or how much is for furniture and all that. The other party does not accept letting out of building without other assets, then the rent is taxable either as business income or income from other sources as the case may be. So in case this 20,000 cannot be split up into how much is for building, how much is for services, how much is for the furniture and other things, and the other person says that without this furniture I will not let out the building, then in that case the income will be taxable under income from other sources or income from business profession as the case may be. Okay, All right, please take about 2 or 3 minutes, go through this. Any questions, please ask me. Any questions, please ask. Please take 2 or 3 minutes. Take about a couple more minutes. Any questions, please ask me. I'm here. Okay, please understand this topic. It's important. Any questions, please ask me. Take about a minute more. Any questions, please ask. Are we done? Okay. Now, income from house property situated outside India. All right. Now, please remember this is the Income Tax Act in India. So, what about the treatment of income from house property situated outside India? In case of a resident in India, a resident and ordinary resident in case of individuals and HUF, we discussed this in the residential status, right? Income from property situated outside India is taxable whether such income is brought to India or not. So if a person residential status is resident and ordinary resident, and if he is earning an income from a property situated outside India, doesn't matter whether he receives it here or not, but it will be taxable in India. Okay. In case of a non-resident or a resident but not ordinary resident in India, income from a property situated outside is taxable in India only if it is received in India. Alright, so the previous topics where we discussed about residential status, now let's discuss that. Resident and ordinary resident. Okay, now when is a person and an individual said to be a resident and an ordinary resident? When he fulfills any one of the first basic conditions. What are the basic conditions? If he's in India for a period of 182 days or more during the relevant previous year, or he's in India for 60 days or more during the relevant previous year, and a total of 365 days or more in the previous 4 years, then he becomes a resident Indian. Okay, if he does not fulfill any of those two conditions, then he becomes a non-resident. Clear? Please go through my last sessions on YouTube on this. All right, now how is a person said to be a resident and ordinary resident? A resident is said to be a resident and ordinary resident if out of the 10 years before the relevant previous year, he has been a resident Indian in 2 out of the last 10 years, or in the 7 years preceding the previous year, he has been in India for 730 days or more. Okay, In this case, he will be a resident and ordinary resident, and in case he does not fulfill any of those two conditions, then he will be a resident but not an ordinary resident. Okay, so now we look at this over here. So resident, not ordinary resident, non-resident, right? So it's very important for you to determine the residential status of an SSC every year in order to find out his taxability. So in the case of income from house property situated outside India, for a resident and ordinary resident, it is taxable in India. For a resident and not ordinary resident, it is not taxable in India. For a non-resident, it is not taxable in India. But please remember, in case if not received in India, so it will be not taxable in India only if that income from the property situated outside India is not received in India. Only then it is not taxable. But if that money is received by the SSC in India, it is taxable, because anyone receives any income in India, it is taxable in India. Please take about 2 or 3 minutes, go through this slide, and then we proceed. Any questions? Please ask me. Okay? Any questions? Please ask. Take about 2 minutes. Any questions, please ask me. Take another minute or so. This is a very important concept as well. Any questions, please ask me. Anyone, any questions? Take another 10-15 seconds more, and then we proceed. All right. Okay. Now, remember I told you in the first slide, we need to determine the gross annual value of a property, and then from that we need to determine the net annual value. So this is another important concept. Please pay attention. Determination of gross annual value, GAV. From that we deduct the municipal taxes paid by the owner during the previous year, and we arrive at the net annual value. So what are the municipal taxes? Please remember, in India, for any house property that you own, there are taxes that need to be paid to the local authorities. Okay, for the upkeep of the properties and the other things. So that is known as municipal taxes paid by the owner during the previous year. So from the gross annual value, you reduce the municipal taxes, and then you arrive at the net annual value. So GAV minus municipal taxes gives you NAV. Okay, you need to remember this. Now, determination of annual value for different types of houses. Now, different types of house property. Okay, now let's look at the first situation, and we are going to talk about determination of gross annual value for different kinds of house properties. Where the property is let out during the previous year, section 23(1)(a)(b), where the property is let out for the whole year, the GAV should be the higher of. Okay, now the assessee has a house property, and that property is let out for the entire year. Okay, at maybe 20,000 rupees a month. So all from April to March, it is let out at 20,000 rupees a month. In that case, the GAV will be the higher of expected rent and the rent actually received or receivable during the year. From the above GAV computed, municipal taxes paid by the owner during the previous year are to be deducted to arrive at the NAV. So in this case, where the property is let out for the whole year during the year, the gross annual value will be the higher of expected rent and actual rent received or receivable during the year. So expected rent simply means what that property of that size in that locality is expected to earn. Okay, what normal rental that property will get, and the actual rent received or receivable during the year. Why do we say received or receivable during the year? Because there might be a case where the tenant may not be able to pay for a couple of months, and he might say, sir, it's okay, I'll pay you next month or after 5 months. Then in that case, whatever is the rent received or receivable and the higher of the expected rent or the actual rent received or receivable during the year will be taken as the gross annual value, and from that gross annual value, municipal taxes paid by the owner during the previous year is to be deducted to arrive at the NAV. Okay, please take 2 minutes, go through this. Any questions, please ask me. Take about 2 minutes. Any questions, please ask me. Please take another minute. Any questions, please ask. Any questions, please ask. Let me know once you're done. Okay, now let's take an example, and I want you all to work it out for me. Example, J owns 5 houses in Chennai, all of which are let out. Compute the GAV of each house from the information given below. Okay, now I will work it out. I will work out 1 for you, and the remaining 4 I want you to work it out for me. Okay, now please remember the rule for calculating gross annual value always goes in 3 steps. First step, higher of municipal value and fair rent. Okay, you let's say this is A. Okay, you then lower of A and standard rent. Let's say this is B. Then higher of B and actual rent. This will be C. So C will always be your GAV. So the 3 steps involved in selecting the GAV is higher of municipal value. See, now what is municipal value? Municipal value means in a particular area, the municipal authorities decide a particular value based on which they charge municipal taxes. All right. And fair rent means according to according to the area and things like that, what is the fair rent expected from that property. Now standard rent is in certain states we have a rent control act that the rent for this kind of property, this size of property cannot exceed a particular amount. So that is the standard rent. It is applicable in a few states, it is not applicable in a few states. And then we have the actual rent received or receivable, which means the actual rent received at 20,000 rupees a month, or maybe a couple of months it's not received, but it is receivable. So the whole formula goes to calculate the GAV is first higher off this and this, we get an amount. That amount and standard rent, the lower of that amount, then that lower amount and actual rent received or receivable, the higher amount, that will be the gross annual value. So let me do the first one for you, then I will give you about 3 or 4 minutes, then you do the remaining. Now for house one, between 80,000 and 90,000, between municipal value and fair rent, which is higher? 90,000. Now between 90,000 and standard rent of 0, which is lower? 0. Right? Now between 0 and 72, which is higher? 72,000. So here in for house 1, the GAV is 72,000. Got it? Okay, now take about 2 minutes, 3 minutes. Do it for house 2, 3, 4 and 5 for me. See the formula on top and try and calculate the GAV for house 2, house 3, house 4, house 5 for me, please. Take about 2 or 3 minutes. Any questions, please ask. Then we'll work it out together. Come on, quickly work it out. Tell me. Let me know once you're done. Okay, are you done? Or you require another 2 more minutes? Okay, Rohit, you require 2 more minutes. All right, take 2 more minutes. Try and finish it off and tell me. Calculate the GAV for all the 5 properties. One I have done. The remaining 4, please do it. Take another 2 minutes. Do it. Take another minute. Any questions, please ask me. Take another 30 seconds. Are we done? Okay, now here's the solution to it. Okay, as per section 23(1), the gross annual value is higher of the expected rent and actual rent received. Expected rent is higher of municipal value and fair rent, but restricted to standard rent. So it's nothing else but those three steps that I told you. So you need to remember these three steps. First, you need to take the higher of municipal value and fair rent, that amount, and the standard rent take the lower amount. When that lower amount and actual rent received and receivable, the higher amount. That will be the gross annual value. Okay, now let's look at the solution here. In the first one, we did it right. First one was 72,000, so that's how we got, because municipal value and fair rent, which is higher, 90,000. 90,000 and standard rent, which is lower, the standard rent. Standard rent and 72,000, which is higher, 72,000. Now let's go to house 2. Between 55,000 municipal value and fair rent, which is higher, 60,000. Between 60,000 and standard rent, which is lower, 60,000. Between 60,000 and 72,000, which is higher, 72,000. So we take the gross annual value of the second house is 72,000 again. Okay. Then house 3, both are the same, municipal value and fair rent. So we take any. This and the standard rent, which is lower, 58,000. Now between 58,000 and 60,000 of actual rent received or receivable, which is higher, 60,000. So we take the gross annual value as 60,000. House 4, between municipal value and fair rent, which is higher, 25,000. Between 25,000 and 0, which is lower, 0. Between 0 and 30, which is higher, 30,000. So the gross annual value is 30,000. Now let's come to house number 5. Between 80,000 municipal value and fair rent, 75,000, which is higher, 80,000. Between 80,000 and 78,000 standard rent, which is lower, standard rent. Between 78,000 and 72,000 actual rent received, which is higher, 78,000. So the gross annual values of the properties are 72,000, 72,000, 60,000, 30,000, 78,000. Okay, that's your solution. Please take about 2 minutes, peacefully go through it and see if you've got the right answer. Any questions you have, please ask me. Any questions, please ask and see if you've got the right answer. We just worked it out for you. Yes? Got it? Any questions? Any questions, please ask me. Okay, now this was the situation where the property is let out for the whole year. Okay, that was how we calculate the gross annual value. Now let's take the second situation where the property let out is vacant for part of the year. Where the let out property is vacant for part of the year and owing to such vacancy, the actual rent is lower than the expected rent, then the actual rent received or receivable will be the gross annual value of the property, which simply means, let's say the property was let out at 20,000 per month for 12 months, but in the year out of the 12 months, 4 months the property was vacant. So how much is the actual rent received? 1,60,000. But how much it should have been if the property would not have been vacant? It would have been 2,40,000, right? So then in that case, if only because of its vacancy the actual rent receivable is lesser than the expected rent, then the actual rent receivable will be the gross annual value of the property. Okay, we will see examples of that as we go further, but for now you just need to remember this and pay attention to this. Are you clear about this? Okay, now in the case of self-occupied property or unoccupied property, okay, now the property, a person holds a property but it is unoccupied or it is self-occupied. Where the property is self-occupied for own residence or unoccupied throughout the previous year, its annual value will be nil provided no other benefit is derived by the owner from such property. So if the property is self-occupied, that means the owner lives in that property himself, or for the whole year it is unoccupied, then the gross annual value of the property will be 0, provided he does not derive any other benefit from the property. The benefit of nil annual value is available for up to 2 self-occupied or unoccupied house properties, that is for either one house and or for 2 house properties. So let's say a person has he owns 2 house properties and both those house properties are not let out and it's lying vacant. In that case, he can treat both those properties as self-occupied with the gross annual value as 0 for both those properties. Until a few years back, this was only 1, but recently it has been increased to 2 properties. So a person can own 2 properties and treat both those properties as self-occupied properties. Okay? Then the benefit of nil annual value in respect of 2 self-occupied properties is available only to an individual as HUF. That means only an SSC who is an individual or HUF can avail the benefit of 2 self-occupied properties, whereas a company, association of person, trust or anything cannot take advantage of this provision. So only an individual or HUF can treat 2 self-occupied properties annual value as 0. Okay, and no deduction in respect of municipal taxes is allowed in case of such property. So if your GAV itself is equal to 0, then municipal taxes are not allowed. Okay, you are not allowed to take a deduction for municipal taxes. All right, because from 0 you can't deduct anything, so that the resultant number becomes a negative number. All right, please take about 2 or 3 minutes, go through this, and then we proceed. We will proceed to the other situations. Take about 2 or 3 minutes. Any questions, please ask. Take about a minute more. Any questions, please ask. Take a minute more. Are we done? Okay, now we take the fourth situation where the house property is let out for part of the year and self-occupied for part of the year. Okay, now this is the fourth situation where we need to calculate the gross annual value. So the first situation was when it is let out for the whole year. Second was when it is let out for the whole year but unoccupied for part of the year. Third was when it is self-occupied or unoccupied throughout the year. The fourth situation is where the house property is let out for part of the year and self-occupied for part of the year. So that means 6 months you let it out and 6 months you occupy it yourself. So let's discuss the situation here. If a single unit of property is self-occupied for part of the year and let out for the remaining part of the year, then the expected rent for the whole year will be taken into account for determining the gross annual value. The expected rent for the whole year shall be compared with the actual rent for the let out period, and whichever is higher shall be adopted as GAV. However, municipal taxes for the whole year is allowed as deduction provided it is paid by the owner during the previous year. So again, the municipal taxes for the whole year will be allowed, but whereas your other things, your municipal value, fair value, standard rent, only for that part of the year for which it is let out will be allowed. For the other part, it will be zero. But the municipal taxes for the whole year will be allowed as deduction provided it is paid by the owner during the previous year. We will work out some problems on this. In the meantime, take 2 minutes, go through this. Any questions, please ask me. Any questions, please ask. Take about a minute more. Okay. Now, in case of a deemed to be let out property, now the property is now if a person holds more than two properties, let's say he owns 3 properties, then he is free to choose any 2 properties as self-occupied, and any one property he will have to treat as deemed let out property. Okay, so where the assessee owns more than 2 properties for self-occupation, then the income from any 2 properties at the option of the assessee shall be computed under self-occupied category, and the annual value will be nil. Okay, so if it's 3 properties, out of that 2 properties, he can take the gross annual value as nil, no problem. The third self-occupied unoccupied property shall be treated as the deemed let out properties. This option can be changed after a year in a manner beneficial to the assessee. So if an assessee holds, let's say, 3 properties, for example, it's left up to him which property he wants to take as self-occupied, which property he wants to take as deemed let out, whatever is beneficial to him. In the case of deemed let out property, the expected rent shall be taken as the GAV. Obviously, because it is deemed let out, it is not actually let out. That means you will have an expected rent. The actual rent received or receivable will not be there because it is empty, right? The question of considering actual rent received or receivable does not arise. Consequently, no adjustment is necessary on account of property remaining vacant or unrealized rent. So if it's the third property, obviously there is no actual rent received or receivable, and obviously there is no adjustment on account of property remaining vacant or unrealized rent because it is a deemed let out property. Municipal taxes actually paid by the owner during the previous year in respect of the deemed let out property can be claimed as deduction. So whatever municipal taxes the owner has paid in respect of the deemed let out property, that is the third property, can be claimed in full by the person paying the municipal taxes. So you see, the municipal taxes are not allowed only in cases where it is self-occupied property. All right, this is the 5th case. Please take about 2 or 3 minutes, go through this, and then we proceed. Any questions? Please ask me. Any questions? Please ask. Take 2 or 3 minutes. You need to know this because the problem can be asked from any of these situations. Take about a minute more. Any questions? Please ask me. Any questions? Take about a minute more. Take about 30 seconds more and then we go to the next situation. Any questions? Please ask. Okay, now let's go to the sixth situation. In case of a house property, a portion is let out and a portion is self-occupied. Okay, now there is one house, a portion, that means there are 4 rooms in that, 2 rooms are let out and 2 rooms are self-occupied. How do we treat that? Income from any portion or part of a property which is let out shall be computed separately as if it's a let out property. Category and another portion or part which is self-occupied shall be computed under the self-occupied property. So for 2 bedrooms, you will treat it as let out property, and for 2 bedrooms, you will treat it as self-occupied category. There is no need to treat the whole property as single unit for computation of income from house property, as it is treated for different purposes. Compute municipal valuation, fair rent, standard rent, if not given separately, shall be apportioned between the let out portion and the self-occupied portion, either on plinth area or built up space or on such other reasonable basis. So if there is one house in which there are 4 bedrooms and the fair rent, municipal valuation, standard rent, expected rent for the whole property is given, you will break it up. 50% for 2 bedrooms, 50% for 2 bedrooms, and then accordingly you will calculate the self-occupied property portion and the let out property portion. Okay, property taxes, if given on consolidated basis, can be bifurcated as attributable to each portion of the floor on reasonable basis. So if it's one property which has 4 bedrooms and the municipal taxes are paid for the entire house, you can break it up. For 2 bedrooms let out how much, for self-occupied 2 bedrooms how much. So you'll have to break it up in that way. Yes, please take about 2 minutes, go through this, and then we proceed. Any questions? Please ask. Take 2 minutes. Any questions? Please ask. Take about a minute more. Okay. Now, treatment of unrealized rent. Now, let's say your tenant has not paid you a rent. How do you treat that? The actual rent received or receivable should not include any amount of rent which is not capable of being realized. So, let's say you rented out a property on 20,000 rupees a month. Okay, and the tenant paid you only for 11 months. So that is 2,20,000 rupees. 20,000 rupees is unrealized rent. Now you told him initially, you gave your tenant some time. He said, "Sir, I will pay you in 1 month, 2 months." But later on, he's not paying you. So in case that 20,000 rupees is incapable of being realized, then your expected rent or actual rent receivable will not include that amount. So your expected rent or the actual rent received or receivable will be only 2,20,000 and not 2,40,000. But in case he has told you that, "Sir, I'm having a financial difficulty, I will pay you in 15 days or 1 month or 2 months," and you think that that 20,000 is going to come, then your actual rent received or receivable will include the 2,40,000, which includes the 20,000 as well. However, the following conditions prescribed in Rule 4 should be satisfied. They are: so before you can reduce the amount of unrealized rent from your actual rent, the following conditions should be fulfilled. What? The tenancy is bona fide. That means there should be a bona fide tenancy agreement or a rental agreement, and that tenancy, the tenants and everyone should be genuine and not bogus. The defaulting tenant has vacated or steps have been taken to compel him to vacate the property. So the tenant who failed to pay the money and you are not capable of realizing the money from him, either he should have vacated your property, or if he is not vacated your property, you should have taken adequate steps to compel him to vacate the properties. Now, what are the adequate steps? Either you should have sent him a letter to vacate the property, or still, if he's not listened, at least a legal notice or legal action should have been taken against him to vacate your property. The defaulting tenant is not an occupation of any other property. So let's say if you have many houses, so this defaulting tenant should not be in possession of any other property of the SSE. So if he's not paid the rent for this property, it should not happen that he goes to another property of the SSE and stays there. Okay. The SSE has taken all reasonable steps to institute legal proceedings for recovery of the unpaid rent, or satisfies to the assessing officer that legal proceeding would be useless. So either the owner of the property has taken all the steps to recover that rent from the defaulting tenant, like legal notice and everything, or he should satisfy the assessing officer that legal proceedings would be useless. "Sir, let him go because I can't find him. He's absconding. So it's 20,000 rupees. Let it go." So if these four conditions are fulfilled, then the 20,000 rupees that is unrealized rent can be reduced from the actual rent received or receivable. Otherwise, no. Okay. Please take please take about 2 or 3 minutes. Go through this. Any questions? Please ask me. Any questions, please ask. Take about 2 or 3 minutes. Any questions? Take about a minute more. Let me know once you're done. – 30 seconds more, and then we proceed to the next one. Okay, are we done? Okay, now let's look at municipal taxes, right? Remember, now we always spoke about GAV minus municipal taxes is equal to NAV. Okay, so now let's look at what the municipal taxes means. Municipal taxes or property taxes. Property taxes are allowed as deduction from the GAV subject to the following conditions. It should be borne by the assessee. That means it should be borne by the owner of the house who is paying the taxes for income under house property, and it should be actually paid during the previous year. So the two conditions to claim municipal taxes are: firstly, it should be borne or paid by the assessee or the owner and not anyone else, and it should be paid for the relevant assessment year for which you are claiming the deduction. All right, so accrual basis will not work here. The second condition: if the property taxes levied by the local authority for a particular previous year are not paid during that year, no deduction shall be allowed in the computation of income of house property for that year. So, if in a particular year there is no municipal taxes that are paid, so in that year, no municipal taxes deduction will be allowed from the gross annual value. Okay, in case anything you have, please ask me a question. However, if any subsequent year the arrears are paid, then the amount so paid is allowed as deduction in computation of income from house property for that year. Okay, now let me explain this to you. Let's say we are computing for previous year 2018-19 house property income. Now for 2018-19 the municipal taxes were not paid. So when we compute the income from house property for previous year 18-19, in that year we get no deduction for municipal taxes. Clear? But if this municipal tax is paid in the year 2019-20 along with municipal taxes for 19-20, then when we are calculating the income from house property for the year 19-20, we can claim both of these, because the previous year was paid this year and this year was paid this year. So if whatever municipal taxes are actually paid during a year, those can be claimed as deductions. Are you clear? So let's read it again. However, if in any subsequent year the arrears are paid, so this is the arrears are paid, then the amount so paid is allowed as deduction in the computation of income from house property for that year. Okay. Thus, we find that irrespective of the previous year in which the liability to pay such taxes arises, according to the method of accounting regularly employed by the owner, the deduction in respect of these taxes will be allowed only in the year of actual payment. So, municipal taxes cannot be accrued. It has to be paid, and only when they are paid can you claim a deduction from a gross annual value. Okay? In case of property situated outside India, the taxes levied by local authority of the country in which the property is situated is deductible. So even if you have a house property situated outside India and the local authority of that country charges certain property taxes, that property tax is also allowed as a deduction while calculating the net annual value. In respect of self-occupied, unoccupied house properties for which nil annual benefit is claimed, deduction of municipal taxes is not allowed. So wherever your GAV is equal to 0, municipal taxes are not allowed to be claimed. And what are the cases in which the GAV is 0? It is in unoccupied house or self-occupied property. So for that, from 0 you cannot claim the municipal taxes. All right, I hope it's clear. Please take about 2 or 3 minutes. Any questions, please ask me. Take about 2 or 3 minutes. Any questions, please ask me. Take about a minute more. Any questions, please ask me. Take a minute more. Any questions, please ask. Take about a minute more. Any questions, please ask. Let me know once you're done. Okay. Now let's take a small example. Okay. Now example. R, a British national, is a resident and ordinary resident in India during the previous year 1920. He owns a house in London, which he has let out at £10,000 per month. The municipal taxes paid to the Municipal Corporation of London is pounds 8,000 during the previous year, 1920. The value of £1 in Indian rupee is taken as 92.5. Compute R's net annual value for the year assessment year 2020-21. So a person is a resident and ordinary resident in India, so his global income is going to be taxed in India. So this person owns a house in London, which he has let out at pounds 10,000 per month. The municipal taxes paid to the Municipal Corporation of London is £8,000 during the previous year 1920. The value of £1 in Indian rupee to be taken at 92.5 rupees. Compute R's net annual value of the property for assessment year 2021. Okay, now let's look at the solution. For the previous year 1920, R, a British national, is a resident and ordinary resident in India. Therefore, the income received by him by way of rent for the house property located in London is to be included in the total income in India. Municipal taxes paid in London is to be allowed as deduction from the gross annual value. So we have discussed this already. Because he's a resident and ordinary resident, his global income will be taxed in India. So whatever house property he's got in London, that will be taxed in India, and the municipal taxes that he pays in London will be treated as deduction from gross annual value. All right, please take 2 minutes, go through this slide, and then we proceed. Take 2 minutes. Any questions, please ask. Take about a minute more. Let me know once you're done. Are we done? Let me know once you're done. Okay, so here's the solution. The gross annual value is £10,000 into 12 into 92.5, that is 1 crore 11 lakh rupees. The municipal taxes paid is pounds 8,000 into 92.5, that is 7 lakh 40. And the net annual value is 1 crore 11 lakhs minus 7 lakhs 40,000, that is 1 crore 3 lakhs 6,000 rupees. Okay, so this is your answer. Got it, everyone? Can we proceed? Take 30 seconds. Okay, now we have found out gross annual value minus municipal taxes is equal to net annual value. Now, from your net annual value also there are certain deductions allowed under section 24. Okay, now what are those deductions? There are two deductions allowed from the net annual value, that is 30% of NAV and interest on borrowed capital. Now please remember there is a standard deduction of 30% that is allowed on the NAV. That includes all your insurance, your repairs, maintenance, depreciation, everything, and over and above that standard deduction of 30%, you're not allowed to take anything else. Okay, so 30% of the NAV is allowed as standard deductions, and then you have interest on borrowed capital. So these are two deductions that are allowed from the net annual value. So let's look at first one. 30% of NAV is allowed as deduction under section 24A. Point number A, this is the flat deduction and is allowed irrespective of the actual expenditure incurred. If the actual expenditure incurred could be less or it could be more, but you are allowed as 30% flat standard deduction. The assessee will not be entitled to a deduction of 30% in the following cases, as the annual value itself is nil. So in the following cases, the standard deduction of 30% will not be allowed because the net annual value only is zero. What are those cases? In case of self-occupied properties, in case of property held as stock in trade and whole or part of the property is not let out during the year or any part of the previous year, up to 2 years from the end of the financial year in which a certificate of completion or construction of property is obtained. So like we discussed in the earlier slides, if a property is self-occupied, the gross annual value is zero, municipal taxes cannot be deducted, net annual value will be zero. So from zero you cannot deduct 30%, so that will not be allowed. And the second case is in case the property of a builder or someone is held as stock in trade who wants to sell the property. So for 2 years you are allowed to take the gross annual value as zero, and and when the gross annual value is zero, the net annual value also will be zero. So from zero you will not be able to take 30%. But 2 years from the time the completion certificate of the property is obtained, if it is zero, after that, then when it will be deemed let out, you can take the 30% standard deduction. All right, please take 2 minutes, go through this. Any questions, please ask. Take 2 or 3 minutes. Any questions, please ask. It's an important slide. Yes, any questions, please ask. Are we done? Please take your time, carefully read it. Any questions, please ask me. Okay, now let's go to the second part. No, so we spoke about the standard deduction under 24A. Now let's talk about interest on borrowed capital. Interest on borrowed capital simply means if you've taken any loan for the construction or purchase of the house property, the interest paid on that can be allowed as deduction under section 24B. Now let's read it. Interest payable on loans borrowed for the purpose of acquisition, that means for purchase, construction, repairs, renewal or construction can be claimed as deduction. Interest payable on a fresh loan taken to repay the original loan raised earlier on the aforesaid purposes is also admissible. So let's say you've taken a loan for purpose of buying a property. To repay that loan, you've taken another loan. In that the interest on that new loan also is allowed as deduction. Now, there are two things. One is interest for pre-construction period and one is interest on post-construction period. Both are allowed as deductions. But the question here is, if let's say you took a loan for purchase of for construction of a property on 1st Jan 2015, okay, and the property was finished construction on 1st Jan 2020. So 15 you took the loan and 20 it was constructed. So what is the pre-construction period? The pre-construction period we are talking about previous year. Okay, so let's say loan taken on 1/1/15, construction completed on 1/1/20. Okay, so what is the pre-construction period? Which financial years? 14-15, 15-16, 16-17, 17-18, 18-19. Okay, so 1, 2, 3, 4, 5. 5 financial years are pre-construction period because in the year 1920 the construction was complete. So this clause simply says whatever interest you've paid during 14-15, 15-16, 16-17, 17-18, 18-19, that is known as the pre-construction period, that interest can be claimed from the year in which the construction is complete, which is 1920. Okay, but not the entire amount. It will be divided by 5 and it will be claimed as 5 equal installments right from the year in which the construction is complete. Okay, so let's read it. Instruction for pre-construction period. Pre-construction period is the period prior to the previous year, like we discussed, in which the property is acquired or construction is completed. Interest payable on demand on borrowed capital for the period prior to the previous year in which the property has been acquired or constructed. Pre-construction interest as reduced by any part thereof as allowed as deduction can be claimed as a deduction over a period of 5 years in equal installments commencing from the year of acquisition or completion of construction. So in the above example, from the year 1920, the entire interest that we paid in 14, 15, 15, 16, 16, 17, 17, 18, 18, 19 can be claimed in 5 equal installments starting from the financial year 1920. Okay, this is the interest for pre-construction period. Are we clear? Any questions? Now, interest for the year in which construction is complete or property acquired. So for financial year 1920, what will happen? Interest relating to the year of completion of a construction, acquisition of property can be fully claimed in that year irrespective of the date of completion. So whatever is the interest for the financial year 1920 can be claimed in the year 1920 without any restrictions, and you can claim the pre-construction interest divided by 5 from the year in which your construction is complete. Okay, this is a very important concept. Please go through this. Take about 2 or 3 minutes and then we proceed. Any questions, please ask. Any questions, please ask. Take 2 or 3 minutes, carefully read this. Any questions, please ask me. Take about 2 more minutes. Any questions, please ask me. Any questions? Take about a minute more. Yeah, take a minute more. This is an important concept. Are we done? Okay, now deduction in respect of self-occupied or unoccupied property where annual value is nil. So, like we discussed in the previous slides also, self-occupied or unoccupied property, the annual value, the NAV is 0. Now the question is, from that the standard deduction cannot be reduced, but now can we reduce the interest on capital is the question. The answer is yes. In this case, the assessee will be allowed a deduction on account of interest, including 1/5 of the accumulated interest of pre-construction period as under. If the loan was borrowed before 1499, where the property has been acquired, constructed, repaired, renewed, or reconstructed with borrowed capital before 1499, the actual interest payable in aggregate for one or two self-occupied properties subject to a maximum of rupees 30,000. So if the loan was taken prior to 1499, the amount of deduction available along with pre-construction interest is 30,000 only. If the loan is borrowed on or after 1499, where the property is acquired or constructed with capital borrowed on or after 1999, and such acquisition or construction is completed within 5 years from the end of the financial year in which the capital was borrowed, actual interest payable in aggregate to one or two of such self-occupied properties subject to a maximum of rupees 2 lakhs if the certificate mentioned in 2 is obtained. So the second condition is the loan is taken after 1/4/1999 and the construction is completed within 5 years from the date of taking the loan, then 2 lakhs interest on the loan borrowed up to rupees 2 lakhs is allowed as a deduction, provided the certificate is obtained and the construction is completed within the allotted 5 years. And also this is the aggregate, the total for one or two self-occupied properties cannot exceed rupees 2 lakhs. Got it? Now, then the next point on this is where the property is repaired, renewed, or constructed with capital borrowed on or after 1/4/1999, actual interest payable in aggregate for one or two self-occupied properties subject to a maximum of 30,000. So if there is any loan taken for acquiring or constructing or reconstructing a property, then it is 2 lakhs. But if it is for repairs or renewals of a property, then it is limited to 30,000 rupees. Okay? Yeah, please take about 2 or 3 minutes. It's an important slide. Go through this and then we proceed. Any questions, please ask. Take about 2 or 3 minutes. Any questions, please ask. It's an important slide. Any questions, please ask. Take about a minute more. Any questions, please ask me. Any questions? Any questions, please ask. Okay, now let's look at an example. Please pay attention. Example, Mr. M, who owns two house properties, one at Bombay, which his family resides, and the other at Delhi, which is unoccupied. He lives in Chandigarh for his employment purposes in a rented house. For acquisition of the house property at Bombay, he has taken a loan of rupees 30 lakhs at 10% per annum on 1/4/2018. Okay, he has not repaid any amount so far. In respect of house property at Delhi, he has taken a loan of rupees 5 lakhs at 11% per annum on 1/10/2018. So he's taken two loans. One is on 1/4/2018 for 30 lakhs and on 1/10/2018 for 5 lakhs towards repairs. Compute the deduction which would be available to him under section 24B for assessment year 2021 in respect of the interest payable on such a loan. Okay, so he has two houses, one in Bombay, one in Delhi. For the acquisition of the house in Bombay, he had taken a loan for 30 lakhs at 10% per annum on 1/4/2018. And for the one in Delhi, he took a loan of 5 lakhs at 11% per annum on 1/10/2018. Now we need to compute the deduction that is allowed to him under section 24B for assessment year 2021 in respect of interest on such loan. So let's look at the solution. Interest on loan taken for acquisition of residential house property at Bombay is rupees 30 lakhs into 10, 3 lakhs restricted to 2 lakhs. Okay. Interest on loan taken for repairs of residential house property in Delhi, 5 lakhs into 11% is 55,000 restricted to 30,000 rupees, because for repairs or renewal it is only 30,000 rupees. So deduction under section 24B in respect of 1 and 2 above is restricted to 2 lakhs. So the total interest paid is 2 lakhs plus 55,000, but it is restricted to 2 lakhs only as per section 24B. Okay, please take about 2 or 3 minutes, go through this. Any questions, please ask me. Any questions, please ask. Take about 2 or 3 minutes. Any questions, please ask me. Take 2 more minutes. Any questions, please ask. Take another minute or so. Take another minute. Any questions, please ask. Are you done? Are we done? Let me know, please. Okay, if you're done, let's take a break for about 5 to 10 minutes and then we will continue. Okay, just take a break for 5 to 10 minutes, freshen up, have some water, and go and catch up on some snack. And I'll join you back in about 5 to 10 minutes. All right? Yeah. Right. Okay. Are we all done? Are we all back? Let's proceed. Okay, let's proceed with this. So this is where we stopped last class. So are you all clear with this solution? Any questions here? Okay, so on the Bombay property acquisition, 3 lakhs is allowed, but restricted to 2 lakhs. And interest on repair of the residential house, only 30,000, it's 55 lakhs into 11%, but restricted to 30,000. So 2 lakhs plus 30,000 restricted to 2 lakhs. Okay, now here are important points pertaining to the previous. The ceiling limit would not apply to let out or deemed let out property. The ceiling prescribed for self-occupied property as above in respect of interest on loan borrowed does not apply to let out or deemed let out property. So this ceiling, what we saw, 3 lakhs and 2 lakhs, 30,000 and 2 lakhs is applicable only to self-occupied or unoccupied property. But where your property is let out or it is deemed let out property, in this cases that ceiling of 30,000 or 2 lakhs does not apply, and whatever interest you paid actually without any limit, it is allowed in your deduction under section 24B. Are we clear? Now, interest allowable on accrual basis. Deduction under section 24B of the interest is available in accrual basis. Therefore, interest accrued but not paid during the year can also be claimed. So, unlike your municipal taxes, which are allowed only when it is paid, your interest is allowed even when it is accrued. So, even if it is accrued and not paid to the bank or the financial institution, it can still be claimed, but provided you get a certificate from the banking or the financial institutions. Okay. Unpaid purchase price will be considered as capital borrowed, where the buyer enters into an arrangement with the seller to pay the sale price in installments along with interest due thereon. The seller becomes the lender in relation to the unpaid purchase price and the buyer becomes the borrower. In such a case, unpaid purchase price can be treated as borrowed capital for acquiring property, and interest paid thereon can be allowed as deduction. So let's say that the buyer has entered into an agreement with the seller for purchasing the property for X amount, but the buyer has not paid the entire amount to the seller. So whatever amount he has not paid, that can be treated as borrowed capital, and in case the seller charges any interest on that, that interest can be claimed under deduction as a deduction under section 24B as interest on capital borrowed. That's what it means. Okay, interest on unpaid interest is not deductible. Now if there is any interest charged on interest that is payable, that amount is not deductible, but only the first instance of interest is deductible. Okay, so these are some additional points pertaining to this problem that we saw, and the interest on house property under section 24B. That is what amount is deductible, what amount is not deductible. Please take about 3 or 4 minutes, go through this. It's important. Any questions, please ask me, and then we proceed. Any questions, please ask. Any questions, please ask. Take about 3 or 4 minutes. Take about a minute more. Any questions, please ask me. Any questions, please ask me. Take another minute. Let me know once you're done. Okay, now let's look at an example. The let out property for the full year. Now I want you to work it out. Okay, now we have explained the entire problem. The entire problem is here, and all the provisions of the income from house property has been explained. Now towards the end of this chapter. Now I want you to take about 5 to 7 minutes, solve the problem, and let me know. Okay. Now let's read the question. Now A has a property whose municipal valuation is rupees 1,30,000. The fair rent is rupees 1,10,000, and the standard rent fixed by the Rent Control Act is 1,20,000. The property was let out for a rent of rupees 11,000 per month throughout the previous year. Unrealized rent was rupees 11,000, and all conditions prescribed by Rule 4 are satisfied. He paid municipal taxes at 10% of the municipal valuation. Interest on borrowed capital was rupees 40,000 for the year. Compute the income from house property for A for assessment year 2021. Okay, now this contains most of the provisions what we've discussed so far. I want you to take about 5 to 7 minutes. Ignore the solution part of it. I want you to take about 5 to 7 minutes and give me the answer. I want you to give me the answer of compute the income from house property of A for the assessment year 2021. All right, take about 5 to 7 minutes, work it out and give me the answer. You should be able to work it out by now. Take about 5 to 7 minutes. It shouldn't take you that long, but still. Yes, I hope you're working it out. Take about 3 or 4 minutes more. Yes, work it out and then we will see the solution together. Right, take about 3 or 4 minutes more. Work out this problem, give me the answer. We are towards the end of this topic, so I want you to work it out yourself. Try it, try it. Take another 2 to 3 minutes. Any questions, please ask. Take another 2 minutes. Quickly finish it. Let me know once you're done. I'm waiting. Okay. So I hope you would have done it. So let's first find out the GAV. Okay, now GAV, let's read the municipal valuation is 1,30,000, fair rent is 110. So higher of the two is 1,30,000. So 1,30,000 and standard rent 1,20,000, which is lower, 1,20,000, and 1,20,000 and the property was let out for 11,000 per month for previous year, and the unrealized rent was 11,000. So 11 into 11, 1,21,000. So the unrealized rent, that means all the other conditions for unrealized rent is met. That means the tenancy was bona fide. He took all the steps for receipt of the money, but he did not get the money. So the actual rent received is 1,21,000. So 1,20,000 and 1,21,000, which is higher, 1,21,000. So that is your gross annual value. Okay, so that's what the solution also says here. Computation of expected rent, higher of municipal value and fair rent 1,10,000, but restricted to standard rent of 1,20,000. Compute actual rent received receivable. Actual rent received or receivable less unrealized rent as per rule 4 is 1,21,000. That's what we computed. So compare expected rent of 1,20,000 and actual rent receivable of 1,21,000, which is higher, 1,21,000. So GAV is the higher of expected rent and actual rent received or receivable, 1,21,000. Are we clear so far? Any questions? Take a minute, go through this. Any questions? Please ask. Take about 30 seconds more. Any questions, please ask me. So we've got the gross annual value of 1,21,000 rupees. Done? Okay, then the municipal, then the gross annual value of 1,21,000. Then he says the municipal taxes are 10% of municipal valuation. What is the municipal valuation? 1,30,000. So less municipal taxes paid by the owner during the previous year, 10% of 1,30,000, 13,000 rupees. So your net annual value is 1,21,000 minus 13,000, that is 1,08,000. Are we clear? Net annual value is also always gross annual value minus municipal taxes. Municipal taxes given in the question is 10% of municipal valuation. Municipal valuation is 1,30,000. Then, so this is your net annual value. From the net annual value, firstly, we'll do a standard deduction under section 24A. That is nothing else but 1,08,000 into 30%. That is 32,400. So that is reduced. Yes. Then the next one is under 24B. Interest on borrowed capital actual without any ceiling, because it is a let out property and it is given here as 40,000 rupees for the year. So without any limit, 40,000 rupees is deducted here. So income from house property is 1,08,000 NAV minus 32,400 minus 40,000, which is equal to rupees 35,600. Okay, that is your income from house property. I hope all of you got it. In case you have not got it, take about 2 minutes, go through this slide and then we proceed. Okay, take about 2 minutes, go through the solution. Any questions, please ask. Take about a minute more. Take about a minute more. Any questions, please ask me. That's the solution. All right, try and read the question here carefully. Go through the answer. Any questions you have, please ask me. Okay, here's the question. Go through the answer as well. Any questions, please ask me. Take another minute. Any questions, please ask. Another 30 seconds and then we proceed. I hope you all have got the answer. Okay, now let's proceed. So now we first, the previous example we saw, which was let out for the whole year with unrealized rent. Now we are looking at let out property vacant for part of the year. Okay. Now example, G has a property whose municipal valuation is 2,50,000. The fair rent is rupees 2 lakhs. Standard rent fixed by the Government Rent Control Act is 2,10,000. The property was let out for a rent of rupees 20,000 per month. However, the tenant vacated the property on 31/1/2020. Okay, and unrealized rent was rupees 20,000 and all conditions prescribed by Rule 4 are satisfied. He paid municipal taxes at 8% of municipal valuation. Interest on borrowed capital was 65,000 for the year. Compute the income from house property or for G for assessment year 2021. Okay, let's read the question again. G has a property whose municipal valuation is rupees 2,50,000 per annum. The fair rent is rupees 2 lakhs per annum and the standard rent fixed by the Rent Control Act is rupees 2,10,000 per annum. The property was let out for a rent of rupees 20,000 per month. However, the tenant vacated the property on 31/1/2020. Unrealized rent was rupees 20,000 and all conditions prescribed by Rule 4 are satisfied. He paid municipal taxes at 8% of the municipal valuation. Interest on borrowed capital was rupees 65,000 for the year. Compute the income from house property of G for assessment year 2021. Okay, now this is little similar to what we did in the last problem. So now again I will give you about 5 minutes. Try solving the problem and then we will solve it together. Take about 5 minutes, try solving the problem and give me the answer. Take about 5 minutes, try solving the problem. Try doing it. I hope all of you are doing it. You don't require 5 minutes, but I'm still giving you 5 minutes for this. Try doing it. Let me know once you're done. Take another 2 minutes. Try it. And give me the answer. Take about a minute more. Try it. We're almost at the end of the topic. Okay, so let's look at the solution. Now again, the same exercise as last time. Municipal valuation and fair rent, which is higher, 2,50,000. 2,50,000 and standard rent, 2,10,000, which is lower, 2,10,000. The property was let out for a rent of rupees 20,000 per month. However, the tenant vacated on 31/1. So for 9 months, it was for 10 months it was occupied. So 20,000 into 10 months, 20 lakhs and 2 lakhs and 2 lakhs minus 20,000 is the unrealized rent. So 1,80,000 rupees. Okay, so if for the 2 months he would have still given the property on rent, he would have got another 40,000. So you would have got 2,20,000. So let's start. Compute higher of municipal valuation and fair rent, 2,50,000 and 2 lakh, but restricted to 2,10,000. So correct. Then compute the actual rent received or receivable. Actual rent received or receivable for the let out period less unrealized rent is equal to 2 lakhs. How do we get 2 lakhs? 2 lakhs 20,000 into 10. 2 lakhs minus 20,000 is this unrealized rent. So 1,80,000 rupees. So compare the expected rent and actual rent received or receivable. Now between 2,10,000 and 1,80,000, which is higher? 2,10,000, right? Correct. But in this case, the actual rent of 1,80,000 is lower than 2,10,000. So actually we should take 2,10,000. But because the property was vacant for 2 months, the actual rent is 1,80,000. In case the property was given out for rent for another 2 months, then the property value would have been 2,20,000. How 2,20,000? 1,80,000 plus 40,000. That is February and March. So 2,20,000, right? Therefore, the actual rent received is the GAV. So 1,80,000 is the GAV, even though it is less than 2,10,000. Clear? Then, so the gross annual value of the property is 1,80,000 less municipal taxes, 8% of municipal valuation. Here he says 8% of municipal valuation. So 8% of 2,50,000 is 20,000 rupees. So 1,80,000 minus 20 is 1,60,000. So the NAV is 1,60,000 rupees. Clear so far? Then from that we deduct 30%. So 1,60,000 into 30% is 48,000. That is a standard deduction under 24A. Okay. And then the interest on borrowed capital, actually without any ceiling, 65,000. 65,000 is given to you in the problem here. Now because the property was let out, there is no ceiling on the interest that is paid. Got it? So the income from house property is equal to 47,000. How do we get 47,000 rupees? How do we get 47,000 rupees? 1,60,000 minus 48,000 minus 65,000 is 47,000 rupees. So that is your solution. So the income from house property is 47,000 rupees. Please take about 2 or 3 minutes. Go through the solution. In case you have any questions, please ask me. Okay, take about 2 more minutes. Any questions, please ask me. Any questions, please ask. Take about a minute more. Here's the solution. Take a minute, go through this. Are we done? Any questions? Okay, if you're done, we will be... Okay, are you done? Take about 10 more seconds. Okay, so if you're done, we will end this session now. We will continue in the next session tomorrow. So thank you so much for being a wonderful audience, and we will continue with the next session tomorrow. Okay, right. Thank you so much, and see you all tomorrow.